Welcome to today's lecture. Today our topic will be central banking and central banks. We've talked a lot about commercial banks and the way commercial banks do business, the German banking sector in particular, and some theoretical models why banks exist and what are the functions of a bank in an economy. And you cannot talk about banking without also talking a little bit about central banking and the role the central bank plays in an economy. And because of these numerous interrelations between a commercial bank, a private commercial bank, and the central bank, I also want to discuss the basic features and the most important facts about central banks here, although this is a business lecture. So we are currently at this point here, the role of central banks, before we continue to talk about business models, accounting, risk management, etc. And let me first ask you, has any one of you already taken a class on central banking, financial intermediation? Okay, just one student. Okay. You will probably know the most basic tasks and duties of a central bank. It gives out money, and I think the easiest way to understand what a central bank does is to look at the balance sheet of a central bank, because just like any other regular bank, a central bank also has a balance sheet with an asset and a liability side, and will easily see what a central bank does in an economy by simply looking at the asset and the liability side of its balance sheet. Now, in the European Union, you're probably aware of the fact that we have a very special system in which we do not only have one single central bank, but we actually have a central banking system that consists of the European Central Bank and all the national central banks of each country. And we also have to make a distinction between the Euro system and the European Union, or to be precise, the European Economic, the EEA area. Now, why is that? Because formally, the European Central Bank, together with the national central banks, forms the European system of central banks. In German, it's not the EZB, but the ESZB, the Europäische System der Zentralbanken. In English, it's the European System of Central Banks. And in the case of Germany, this is Deutsche Bundesbank, the German central bank. It used to be completely sovereign and used to be the sole central bank for Germany, at least first for Western Germany and then after reunification for the whole of Germany. But nowadays it has given up some of these duties to the European Central Bank. And together the ESCB, the European System of Central Bank, is the central bank for the European Union countries. It's a little bit complicated because the majority of countries in the European Union are also part of the Euro system. And for the countries which are in the Euro system, the European Central Bank, of course, has a much larger role, plays a larger role. Usually for a central bank, its main task and its main duty is to secure price stability. And this is especially true for Germany because Deutsche Bundesbank has always been very proud to be the defender of the local currency, the defender of the Deutsche Mark, because it was very successful in guaranteeing price stability and very successful in fighting inflation and hyperinflation during the years of up until we introduced the euro. Usually, the second most important goal of a central bank is the support of general economic policy. So usually a central bank will try to fight inflation and to secure price stability. And if it's possible to secure price stability, to guarantee that inflation does not increase by too much, and still support the general economic policy of the government, the central bank will, of course, try to do so. Nevertheless, usually central banks are quite independent of the current government, and they are able to put a higher and larger emphasis on securing price stability rather than just being the helper of the government in supporting the government's economic policy. Depending on the legal form of the central banks can, of course, differ from state to state and from country to country. And it's interesting to note that some of the central banks are incorporated and have stocks that are traded on stock exchanges. Usually the government or the state will hold the majority or will hold all shares in the central bank, but it's not like the central bank always has to have always needs to be organized in a special legal form. For example, in Germany, this is different. Deutsche Bundesbank is not a stock company, but it's in a special legal form only available to government-run and government-owned companies. In other states, for example, Switzerland, the central bank is a stock company and has stocks. And if you know this fact, it's of course quite easy to see that a bank, especially one that is organized as a stock company, also has a balance sheet. And now to understand the functions of a central bank, it's quite informative, I think, to imagine a situation in which you were to form your own country. You have just founded your own country and you are in need of a central bank. Why are you in need of a central bank? What's the basic and the simplest duty a central bank has?
Well, you need someone to provide money.
You have to have a central bank in order to print money, to provide your citizens with a unique and single form of currency. So you want to print money. What has the central bank to do now? What is the usual way central banks create money? They can print money, but what do they have to do?
They buy some state
assets?
Yeah. From the state and then they give it out.
It doesn't necessarily have to come from the government.
It can also be private.
Yeah. So you would say that, okay, we've now founded our central bank for our small island republic, and we want to print money. So what happens? Where does the money, let's say we print 1 million units of currency as money. Where should we put it? Is it an asset or a liability? Yes, it's a liability because it's a claim against the central bank. And what could you buy as assets? What was done traditionally in history? Shares, for example. Another example of assets the central bank could buy up. And so assume we have equity by the state, and here we've given out, I would say, paper money as a liability because it's a claim against the central bank. But what does the central bank buy in addition to shares and stocks of, for example, companies? Imagine a small island where you do not even have a company from which you could buy stocks.
State bonds or how it is.
State bonds, sovereign bonds. Even simpler. At the very beginning in history, when countries started to form their first central banks, they started to buy up gold and other simple assets that private households and governments possessed. So you could buy up gold. You could also start to buy up foreign currencies at, of course, an exchange rate. And you have certain assets on your asset side of the balance sheet, and you give out paper money, which are simply claims against the central bank. So this is quite simple. If you look at the asset side, Now, to make it a little more complex, usually the central bank will keep a certain currency reserve in gold and foreign currencies on its asset side. It will have the refinancing of commercial banks. It will have claims. The central bank will have claims against commercial banks. It will sometimes also grant loans to the state, which is quite controversial. And in many countries, of course, the central bank is forbidden to do this. And it can also engage in open market transactions, which is the purchase of securities. And this is something done quite enormously at this time by the European Central Bank. It buys up, well, what? Sovereign bonds and corporate bonds. It buys up bonds by other agents in the market, and it puts the bonds, of course, on its asset side. And why is the central bank doing this? Is it printing money? Any idea? Well, it's giving out loans to commercial banks. One idea is to buy up sovereign bonds, for example, from Greece and other countries. Why? Because the central bank is now able and is willing to finance the sovereign debt of these countries in the euro system. In other words, it gives out money to governments like Greece so that they are able to finance their deficit. Otherwise, Greece would be bankrupt and insolvent and default. And another reason, why is the European Central Bank buying up, for example, corporate bonds and other bonds also from other agents? Because it wants to, well, not print money, but it wants to give out loans, especially to commercial banks, so that commercial banks are able to grant loans to firms, which will increase innovation and employment. This is usually the motivation for the central bank to for quantitative easing. This is what it's called. The central bank intends to give out loans to commercial banks so that commercial banks on their own are able to give out more loans to firms, which will then again create jobs and increase economic growth. So we have open market transactions on the asset side here. Okay, that's not me. And on the liability side, what do we have here? First, the central bank, just as I've described for this imaginary central bank of a small island, it will give out paper money. So the paper money you have in your wallet is a claim against the central bank. And is someone here from the UK, perhaps, or another country from the Commonwealth? No? If you look at a pound note, and I think it should also be on the Canadian dollar and some other currencies within the Commonwealth, it already states on the banknote, I, the governor or treasurer of the Bank of England, hereby promise to pay the bearer of this note the amount of £5. So the banknote actually tells you that this is a claim against the Bank of England. So you know that paper money is actually something you can demand from an amount you can demand to be paid out by the central bank. And historically, these paper money banknotes were, of course, a claim against gold, claim for gold against the central bank. You also have commercial banks deposits. Usually you as a private household cannot deposit money with a central bank, but commercial banks can. If commercial banks have too much liquidity, they can put this excess liquidity in the balance sheet of the central bank, and in normal times, commercial banks will get a very small interest rate on their central bank deposits. And the central bank also has the state deposits. So the central bank usually also runs the accounts for all government agencies and the public sector. If you have ever received a payment from a government agency, or if you, for example, have received a scholarship from the state, or if you have already been forced to pay taxes, you might have noticed that usually the state agencies have an account with Deutsche Bundesbank. And funny little anecdote, the first time I visited the research center at Deutsche Bundesbank, one thing the people were, the employees of Deutsche Bundesbank were extremely proud of was their Deutsche Bundesbank accounts card and savings and accounts card, EC-Karte, the Euro used to be Euro check card. As you might know, in Germany, everyone has a banking card, and we are able to pay with our banking card almost everywhere. And these cards are issued by the Sparkasse, by the Volksbank, or by Deutsche Bank. And the employees of Deutsche Bundesbank, of course, do not have to go to a private bank to open a bank account. They have their own bank account with Deutsche Bundesbank, and they have a banking card with the federal eagle on it. Yeah? So, and also, if they go to an ATM machine, they get freshly printed Euro banknotes. So if you are a collector and you are in need of the first print of new banknotes, you have to work for Deutsche Bundesbank. Okay. Yeah.
Yeah, if you have a claim against a central bank and you go to the central bank, will you get an exchange for paper money?
That's a theoretical question. As I've said, when paper money was introduced, it used to be a claim against the central bank in exchange for gold. So you were always able to exchange paper money against gold coins. But this, of course, has changed. But legally, it's a claim against the central bank. So you are now in possession of a tiny percentage of Greek sovereign bonds, I guess. The Ecb balance sheet. You can see the balance sheet of the European Central Bank, date of end of 2013. And you can see a total balance sheet, total assets of almost 174 billion euros. You can see that the European Central Bank has gold assets of almost 14 billion, some claims in foreign currencies of 40 billion euros, and so on. And on the liability side, you can see that it has almost 77 billion euros of euro notes in circulation, and the rest, these are liabilities against commercial banks, against other national central banks. And one weird little entry is if you look at the liability side, right down at the bottom, you can see that you have a balance sheet profit of 1.4 billion euros. The accounting rules for central banks are, of course, slightly different from those rules that apply to commercial and private commercial banks. So in this case, you can enter and you can insert the profit of the central bank on the balance sheet, although it's a part of the income statement. Nevertheless, the balance sheets, also by Deutsche Bundesbank, they are audited. So if you take a look at the annual report of Deutsche Bundesbank, you will find an audit report, I think, by PricewaterhouseCoopers, I think. One of the big auditing company audits Deutsche Bundesbank. Do you notice something when you look at the balance sheet of the European Central Bank? Is there anything striking to you? For example, if you look at the balance sheet total assets. Yeah.
Well, it's not even that high. So
Yeah, it's quite small. The balance sheet, the total assets of the European Central Bank is actually quite small. Do you have an explanation for that?
Because the money is created elsewhere within the private bank. system?
No, not. It's not created in the private banking. If you hear about, for example, the size of the quantitative easing program, it's quite large. The tiny problem here is this is just the European Central Bank, but most of the assets and liabilities are more or less hidden in the balance sheets of the national central banks. So if you want to take a comprehensive look at what happens and what is going on in the euro system, you need to have a look at all the aggregate balance sheet of all national central banks, of Deutsche Bundesbank, Banque de France, Banco de España, etc., and the European Central Bank. This is just the head of the European system of central banks, so you also need to take a look at the balance sheets of the national central banks, because these are the parts of the system that are responsible for performing all the operations that are being decided on in the European Central Bank system. Here you can see the income statement, which is also quite small. You can see that the central bank generates interest rates. It gives out also interest rates to commercial banks. It has 440 million euros cost, or it had costs of 440 million in 2012 for personnel, and actually paid 8 million euros for producing banknotes, and it also had to write down some assets. And here you can see it had an income statement of roughly 11 million euros. So again, not very large, but most of the things that are happening in the euro system are in the balance sheets of the national central banks. Okay. Any questions concerning the asset and liability side of the central bank and the balance sheet? It's very informative to look at the annual report of a central bank. As I've said, the usual accounting rules do not necessarily have to apply to central banks just in the way they do for commercial banks. And the annual reports from central bank to central bank will differ quite strongly, actually. And this is important because it seems to me, at least, that this is a very recent topic for research, and empirical research at least, right now, because starting with a quantitative easing program, theory and economic theory has taken a new and fresh look at the question whether central banks can actually default. If you go back 10 or 15 years, the majority of researchers in economics believe that central banks cannot go bankrupt, they cannot default. But now there are some models out there, for example, by I think Ricardo Reis from, I think he's at Wharton, who has looked theoretically at the question when and how can a central bank default. And there is one research paper by a colleague, he's a German, Martin Schmalz from the University of Michigan, and some other people from Lancaster University. They have looked at earnings management by central banks. Does anyone know what earnings management is? Earnings management. No idea? In German, it's Bilanzpolitik. What does Bilanzpolitik mean? Can you explain Bilanzpolitik? What could it mean? Yeah?
For example, when you keep specific items on the balance sheet, for example, an airline that purchases assets, 2 leases, etc.
In every accounting regime, you will have a few possibilities to legally change figures in your balance sheet. You have some options. You can choose to include a figure and an asset in your balance sheet, or you can opt to leave it out. So usually the rules in an accounting regime are not 100% strict in the sense that if you have these assets and these liabilities, your balance sheet is immediately fixed. You have some discretion to change certain numbers and certain figures in your balance sheet. And if you choose, for example, to include something, and if you choose to legally leave out something, this is what is called earnings management when it is concerned with the overall earnings of your company and your income statement. And in a broader sense, this is the German word Bilanzpolitik, which just translates into balance sheet politics. So the decisions you make to legally change your balance sheet into one direction or another. And again, this is legal. This is not balance sheet fraud, but an accounting fraud, but it's legal because you have certain rights and certain options you can choose from. And these authors, Schmalz, Goncharov, and Ioannidou, they've just shown in a paper that has been out a couple of months, I think, they've shown that central banks do earnings management. And what does earnings management mean? Imagine you have three possible outcomes. You have earnings, you have a profit of, say, minus 1 million. You have a second possible profit of minus 0.01 and a possible profit of plus 1 million euros. Now, what does earnings management mean?
You can easily push your result from minus 1 million to 1 million just by changing, for example, revenue recognition.
Yes, you can try to change your earnings into the right, but this might not be possible for the 1 million euro loss. It's quite difficult to change a 1 million euro loss, say, into a 1 million euro profit. But using earnings management, it should be possible to change the 0.01 million euro loss into, say, a 0.01 profit. So you will change this one into such a slightly positive profit. So this one will change. And this is what earnings management is. In German, we have a saying, aus der roten Null die schwarze Null machen. Yeah? So a minuscule loss in German is a red zero. Yeah? It's almost zero, but it's in the red. It's a loss. And if you turn this red zero into a black zero, it's a slight and only marginal profit. But the black zero looks better than a red zero. Ja? Aus der roten Null die schwarze Null machen. This is earnings management. And this paper shows that, as you can imagine, usually this should look like this, right? And suddenly now, the distribution is not like this, but it's skewed to the right. The distribution of earnings, if you look at a cross-section of banks, and firms, it's slightly screwed to the right. And this is what they show is also observable for central banks. And this is important. Why? For firms, there is a large literature that explains the reasons why private firms do earnings management. They want to look better in front of their shareholders. If you're a manager of a firm and you report a slight loss, it's always worse than reporting a slight profit. So a manager will always do earnings management to look better in front of his shareholders. But why is a central banker doing this? Central bankers usually do not care about profits. And they show why. First, it's the first paper that documents earnings management for central banks. They look at 180 central banks over, I think, 20 or 30 years, and they show that earnings are quite skewed. They are almost all central banks are doing earnings management, And well, usually the explanation is risk aversion by central bankers. If you are a central banker, you are closely connected to politicians, and politicians are your stake and shareholders, and they also do not like the central bank to report losses. But again, this is a little bit different with private firms, because some central banks report horrific losses. Do you know one example of a central bank that over the past few years has reported billions and billions of losses?
Greece, probably.
I'm not so sure about the Bank of Greece, but the Swiss National Bank, Schweizerische Nationalbank, the SNB. And do you know why? The Swiss National Bank has reported billions of francs losses over the past couple of years.
Maybe when they changed the policy of keeping the fixed exchange rate.
It's simply due to the fact that they are trying to control the exchange rate of the franc to the euro. They are willing to accept billions of euros or francs in losses in order to keep the exchange rate between the Schweizer Franken and the euro within a fixed, within some fixed levels. And if this is more important to you than, say, 1 or 2 billion euros of losses, well, then the central bank will take the losses. No? So it's not so obvious why a central bank is doing earnings management. Yeah.
Well, now they don't do it anymore, so the losses should
Yeah.
disappear, right?
Well, they had to give the system up because the losses were too high. Yeah. But up until that point, of course, they reported huge losses. You know, there was, especially when the euro took a downturn, it was more difficult and grew more difficult for them to do this and to intervene in the exchange rate without going fully bankrupt. And this is quite interesting. And this is some research that is being done right now. And you should have a look at some of the annual reports of central banks, because from country to country, the information that is provided in the annual reports is quite different. And we have some topics for master's theses and bachelor theses that are concerned with the annual reports of central banks. We are more interested about looking at the risk management and something the central banks do about financial stability, but even a simple topic like earnings management suddenly becomes interesting just by looking at central banks. Okay. Now, as I've said before, the European system of central bank consists of the European Central Bank and the National Central Bank. It's not equal to the Euro system because not all member states of the European Economic Association and the EEA area and the European Union are also part of the Euro system. And it was introduced in 1999, and its primary objective is to secure price stability. It's not as strict as Deutsche Bundesbank used to be and still is, but it still has the fight against inflation as its main objective. It establishes and implements a common monetary policy within the European Union. It also controls exchange rate policy. It manages foreign exchange reserves. It also supervises credit institutions in the European Union, and the European Central Bank itself is supervising authority and supervising agency for the systemically relevant banks and financial institutions within the Euro system. And it also safeguards financial stability in general, and of course it ensures the proper functioning of payment system and transaction systems. It consists, as I've said, of the national banks, the national central banks, and the European Central Bank, the ECB. It's governed directly under European Union law. There are some provisions within EU law that have, well, how should I put it in English? these laws were enacted for the European Central Bank to be founded, has been the common monetary authority of the member states of the European Monetary Union, as well as a component of the ECB. And as I've already said, it also performs other tasks, not just central banking, but usually most central banks also, in addition to monetary policy and financial supervision and financial stability oversight, they also create the balance sheet of the central bank. That's quite clear, but they also have large research departments, and they also collect statistical data. So the ECB has an extremely large research department and a lot of statistics. And in case of the European Central Bank, it now, since 2014, is also responsible for the financial and regulatory supervision of the systemically relevant banks within the euro system. Now, the ECB is governed by an executive board, not too much, a governing council, the general council, and the supervisory board. And you probably know that right now we have, who is president of the European Central Bank? First one was Wim Duisenberg, then we have Jean-Claude Trichet, and now it's Mario Draghi. Just pick a euro note and you will see his name on it. The supervision of the systemically relevant banks is part of the so-called SSM, the Single Supervisory Mechanism. And within the framework of the SSM, which was installed after the euro crisis, or at the start of the euro crisis, the ECB was allowed to take over the supervision of banks whose balance sheet total exceeds either 30 billion euros or accounts for 20% of a country's economic performance. So there are two possibilities for a bank to become systemically relevant and to be supervised by the European Central Bank. The first one is if its absolute balance sheet, its absolute size is too high and it's too large in terms of balance sheet size. And it can also become systemically relevant if it might be a small bank, but within its home country, it's still one of the largest banks with almost 20% of a country's economic performance on its balance sheet. So take, for example, a country like Slovakia or smaller European countries. It might be that the banking sector is so integrated and so consolidated that there are just 2 or 3 banks that are responsible and take up all of the banking sector. And in these cases, the small bank could also be supervised by the European Central Bank under this rule and within the single supervisory mechanism. The European Central Bank, just like any other central bank, has several tools at its disposal to control monetary policy, to control the amount of money that circulates in the economy. And these are not very specific to the European Central Bank, but these are the standard tools of any central bank. They are usually open market transactions, standing facilities, currency interventions, reserve requirements, and this is new, outright monetary transactions, the OMT decision of the European Central Bank. Now let's start with open market transaction and open market operations. Open market policy is usually the main instrument of any central bank, and it simply means that it can control interest rates and the creation of money within the economy by buying up securities. And in fact, the European Central Bank, well, they did not use to buy up securities, but banks were able to pledge securities and to put them with the central bank, and in exchange, the central bank would give out central bank money to the commercial banks. Of course, the central bank will lay out rules what types of securities can be pledged with the central bank, and this will of course depend on the rating of the security in question. In case of the ECB, the most important open market transaction is the main refinancing instrument, also called the main tender. And it consists of an auction in which commercial banks can receive central bank money in exchange for interest payments and securities. And since the financial crisis, the auction procedure is now performed in a quantity tendering procedure, which means there are two different types of auction. In the first type, you, as a central bank, will simply say, okay, we are giving out money at a fixed interest rate. And in the second type of auction, you will just say how much money is given out, and the banks will say, I'm willing to pay an interest rate of 5, 6, or 7% or 2%, and then the money is distributed according to the best offers made by the commercial banks. And in this case here, the interest rate is fixed. The banks name the desired money amounts, and the interest rate tender procedure here, this is the quantity tendering procedure, and the interest rate tender, in this case, the offered central bank money is allocated to the highest bidding commercial banks. Now, the ECB has currently fixed the interest rate at 0%. So they're using a quantity tendering procedure. This is the first instrument a central bank has. It can offer commercial banks to give out central bank money in exchange for securities. And the central bank will accept, say, AAA rated bonds or AA rated bonds. And in this way, the central bank is able to control the amount of money that circulates in the economy. The central bank will also have standing facilities. And this is a nicer word. The English word is much nicer and more informative than the German word Fazilitäten. This is a word I think no one else uses outside of economics. Fazilitäten is very weird in German, but it's derived from the English facility. And facility, of course, means something that is possible. You have the possibility to get central bank money or to deposit central bank money. And this is what is done by the ECB as well. It's understood as the possibility of commercial banks to short-term invest money or raise liquidity with the central bank as a counterparty. So usually the central bank will offer a standing facility to commercial banks so that commercial banks can receive overnight liquidity, or it can deposit overnight excess liquidity with the central bank. So there will be two interest rates, one for the central banks, for the commercial banks to pay in case they are in need of liquidity, and one interest rate the central bank will pay out to commercial banks in case the commercial banks deposit cash and liquidity with the central bank. Now, the ECB offers the so-called marginal lending facility as well as the deposit facility. Those are the two facilities for depositing and depositing liquidity and getting overnight liquidity. Now, the situation is currently quite perverse, as you know, because right now the marginal lending facility gives commercial banks the opportunity to borrow money, currently 0.25%. And if, as a commercial bank, you have excess liquidity, you will have to pay 0.4% on each euro for the central bank to accept this deposit. So this is the negative interest rate everyone's talking about. It's not an interest rate here within the open market operations. This is fixed at 0%, but the negative interest rate, this is the one here. This is the one of the deposit facility via which commercial banks can deposit overnight liquidity with the central bank. And why is the central bank, why has it put in place a negative interest rate? Because it wants to discourage banks to putting liquidity and cash into the central bank instead of granting loans. The central bank's, the ECB's point is, If, as a bank, you have too much liquidity, well, start giving out loans to firms so that they can create jobs and spur economic growth. And do not waste your liquidity on putting it in a safe deposit with a central bank. Third instrument, currency interventions. Just like in the example of the Schweizerische Nationalbank, the Swiss National Bank, the central bank will use currency interventions to influence exchange rates of its own currency with foreign currencies. For example, euro, dollar, euro, yen, euro, Swiss franc. And your currency interventions are simply buy and sell transactions of the foreign currency. So by decreasing or increasing the supply of its own currency, it can influence the price of the euro against the dollar, yen, etc. And this is done by central banks quite often. Of course, not within the euro system. Within the euro system, we all have fixed interest rates, fixed exchange rates, and there is there are no currency interventions within the euro system. But of course, when it comes to the exchange rates with foreign currencies outside the European Union, and in some cases, these instruments are more important than for other central banks. And these interventions usually become interesting and quite tedious for central banks if the central bank wants to keep a fixed interest rate, fixed exchange rate with another currency. This was true for Switzerland, because do you know why? Why the Swiss National Bank did a lot of currency interventions a couple of years ago?
So that still people come to Switzerland to go on their holidays, or that Swiss firms could still sell their products?
The problem is that the Swiss franc and the Swiss economy is quite strong, and the Swiss currency, the Swiss franc, is extremely expensive. This makes exports from Switzerland to especially the European Union and puts it as a comparative disadvantage. So in order to keep their products cheaper and to guarantee that Swiss companies are still able to export their goods to the European Union, the central bank tried to keep the exchange rate low. And this, of course, if the euro drops and the Swiss franc even appreciates in value, this is quite costly, because you have to buy up your own francs, and you have to invest a lot of money. So the Swiss National Bank stopped this this idea of a fixed of an exchange rate within certain caps. But there are some countries who still do this. For example, the People's Republic of China is very restrictive when it comes to its own currency. Do you know one of the first rules you have to know when it comes to China? Is any one of you ever visited China? You come from China? Yeah. First thing you need to know is, where do you buy renminbi? Where can you buy it, renminbi? Where can you buy the renminbi if you want to go to China? In bank, yes, but in China. Yeah, you cannot buy the Chinese currency, for example, at a local German bank. You have to go to China, and you can only buy a renminbi. This is renminbi. This is the official name, and the unofficial name is yuan, the Chinese yuan. But renminbi is a Chinese term. And you're not allowed to buy renminbi outside of China. So this is the first restriction you have. And of course, China is keeping the currency artificially cheap in order to, for the firms, just like the Swiss companies, in order for them to export more goods to foreign countries. So in most cases, there are not too many currency interventions these days, but as soon as you start to keep your exchange rates within certain boundaries, you need to do more currency interventions. Minimum reserves is also one instrument a central bank has at its disposal, and reserves are a tool for central banks to control the demands of commercial banks for central bank money. These are a proportional bank deposit which have to be deposited at the central bank as a mandatory security. And the level is regularly determined as a percentage of the customer deposits of a bank. We have seen this in the small example of how central banks can create money. The idea behind this is that a bank will receive 100 euros of deposits, and if the minimum reserve is 10%, it has to keep a reserve of 10% of these 100 euros of deposits, and it only can give out 90 euros in the form of loans. And it has to keep a reserve, and in this way, the reserve rate, on the one hand, guarantees the stability of the bank. So by increasing minimum reserves, the central bank can guarantee that the bank is able to repay the deposits, and it has a better ability to repay deposits. But on the other hand, it can also control the credit multiplier by which the central banks and the commercial banks create book money. So if the central bank increases the minimum reserve ratio, it will withdraw liquidity from the commercial banks, and this will make banks safer, but it will also decrease the amount of money that circulates in the economy. Okay. In the European system of central banks, the minimum reserve ratio is currently at 1%. In comparison to this, it's between 0 and 10% for the Fed in the US and 20% in China. Do you know why it is so much higher in China than in the European Union? Idea?
Maybe because by this also the amount of money is held low, and so
that doesn't work, right? Yeah.
Maybe they need more cash.
They need more cash. By increasing the minimum reserve ratio, liquidity is withdrawn from the system. So if you increase, they could have also installed a minimum reserve ratio of, say, 1%. So by increasing 1% to 20%, you withdraw liquidity.
No,
So,
I don't mean the banks, I mean the people in China need more money in cash, not gyro money.
well, that could be one reason, that they need more cash. I think a more plausible reason is that they want to make absolutely sure that banks are able to repay the deposits. At this point, they are more concerned about stability than central bank money. So a higher reserve ratio, of course, stabilizes the banks. And because this is a very large system, I think they are more concerned about stability. Mm-hmm. So the ECB determines the level of the reserve requirement through the liabilities subject to reserve requirements of the previous month. The ECB from month to month calculates the reserve ratios, and there are some positions from the balance sheet that are not entering this calculation of the minimum reserve ratio. And here, of course, every commercial bank has to keep an account with the ECB, and the ECB then calculates on a daily basis the minimum reserve ratio and whether the minimum reserve ratio is violated or not. And last but not least, we also have outright monetary transactions. This is, in fact, quite specific and quite peculiar to the European Central Bank. The previous instruments are more or less used by any central bank. The OMT decision by the European Central Bank is quite quite specific to the European Central Bank. What is it? In 2012, at the start of, does anyone know what outright monetary transactions are and what the OMT decision of the ECB was? Any idea? Famous quote of Mario Draghi. Yeah? Whatever it takes. Yeah? The European Central Bank will do whatever it takes to guarantee the safety and stability of the euro system. And what it does mean is that the European Central Bank decided that it will start a program for the purchase of short-term bonds of current countries in the euro area. There is a fine distinction between asset purchases and the quantitative easing done by the ECB and the very controversial and even more controversial policy of some central banks to directly finance the government and to directly finance the state. Do you know what the difference is? In German, we sometimes we have the same idea that in German die Zentralbank finanziert den Staat und dass die Zentralbank direkt den Staat subventioniert und finanziert und dass es diese illegale Form der Staatsfinanzierung ist und Haushaltsfinanzierung ist. What is okay in this sense and what should not be done by the central bank?
They are allowed to buy these bonds and assets on the open market. So first the private banks have to buy it from the government, and then the central bank buys it from the...
Now the idea is, it goes like this. Imagine the German state. The German state has a budget of, I think, 700, maybe 750 billion euros per year. And it needs revenues of 750 billion euros to finance its budget. Now, as in many other cases, the German state uses debt to finance the current budget. And imagine it needs 70 billion euros and has a deficit of 17 billion euros. So taxes are not enough to finance the budget. What can the German state do? It will
Take a loan.
Take a loan. What type of loan? In 99% of these cases and in 99% of the 7 billion euros?
Government bonds.
Government bond. It will issue government bonds, Staatsanleihen. So it will issue sovereign bonds. And who buys these sovereign bonds?
Banks, investors, and
Private investors, usually private, large institutional investors, and these are pension funds, insurance companies, banks, asset managers. And in case of Greece was not able to finance its budget a couple of years ago, especially in 2011, 2012. Why? Because all the private investors were not willing to buy Greek sovereign bonds. And if this happens, is the Greek state bankrupt? Does it default?
Well, the ECB just said that they will buy all of the Greek bonds anyways. And so
Yeah. The idea is that at first, of course, the government will not be in default, but it could still reduce the current budget. Yeah? We could still say, okay, we have 50 billion euros in budget, and we need to cut expenditure. But of course, this is a multi-period model, and in this case, usually you have to pay back 17 billion or 50 billion euros that you loaned, say 10, 20 years ago. Right now, the German state is paying back the government bonds it issued right after reunification. Those are the bonds that are due now. So you have to pay back money. And if you're not able to raise capital to pay back the old sovereign bonds by issuing new ones, you could default. And in such a situation, the European Central Bank said that we will do whatever is necessary. And this means that in case the rescue facilities of the ESM and the European Financial Stability Fund, EFSF, if all those rescue facilities have been used up, and in case the outright monetary transactions have not been used so far, it means that the European Central Bank will buy up these government bonds. Usually, this is something that central bankers would never ever consider, because this has sometimes been done in history, that central banks bought up the sovereign bonds directly from the state, which simply means that the central bank will print out money and will cause hyperinflation. What the European Central Bank is doing now is, it is not using the outright monetary transactions, it's not using the OMT decision, but it's doing quantitative easing by doing what? It's buying up corporate bonds and sovereign bonds in the secondary market. So, for example, Greece, the Greek state, has issued government bonds. Private investors like banks, insurance companies, pension funds bought those sovereign bonds. And these private investors are now selling some of these bonds to the European Central Bank. But it did not buy those bonds directly from the state, but it bought up the bonds on the secondary market. This is the small distinction why the quantitative easing and the asset purchase program of the European Central Bank is not as controversial as outright monetary transactions would be. And the interesting idea now is that by simply announcing that the ECB would do whatever it takes, it so far was not required to do so. It has not used outright monetary transactions so far, but simply the announcement that the ECB will do whatever it takes has decreased the yields on Greek government bonds, because private investors were assured that the Greek state will not default, and in the worst case, the European Central Bank will bail out Greece. Private investors were now willing to buy up Greek sovereign bonds. And I still recall a couple of years ago, someone told me, who was working for a consulting firm, he told me that his partner, his boss, actually invested a large sum of money in Greek sovereign bonds, because he anticipated that the European Central Bank will always bail out Greece, and he bought up sovereign bonds and invested into Greek corporate and sovereign bonds, and he earned quite a lot of interest rates on those bonds, of course. So this is the OMT decision. Now, closely related to the OMT decision of the European Central Bank, the Central Bank can also and will usually act as a lender of last resort. A lender of last resort, which means that it will always be able, and it can decide, to bail out any financial institution in the economy. It will not necessarily do so. It can always decide on whether a financial institution is systemically relevant. But why? What is the intention of the central bank to bail out a financial institution like a bank? It will try to minimize contagion effects. As you might know, if one bank defaults, there's a risk that you as depositors will indiscriminately run to your banks, and the spillover effects from one bank to the other, the contagion effects, will cause the whole financial system to destabilize. Now, to prevent this, the central bank can decide to bail out a single institution to guarantee the stability of the financial system. And this is what is called a bailout, and the central bank will act as a lender of last resort. Why? Well, the money has to come from the state. No private investor will usually be willing to bail out a private commercial bank because it will face the risk that the money will be lost. So you have to use taxpayers' money to bail out a commercial bank. And this is either done by a special fund of the state, for example, the ESM, and there is also a fund by the German state that was used to buy up Commerzbank. And sometimes the central bank will use its own money to bail out banks. For example, in the US, the Fed bailed out a couple of banks. Do you know how this is done in many cases? Yeah?
I guess the government has two possibilities: giving a loan or otherwise getting shares of the bank. I think that's what they did in the US.
Yeah, in many cases, there are two possibilities actually. First one is to engage in a seasoned equity offering. So the bank will raise capital. Usually, if the bank that is close to default, if it raises capital, no one is willing to buy its equity, its fresh equity. But in this case, the central bank or the state will buy up the new equity. So you will raise equity to increase your equity ratio. And the second possibility is what was done during the financial crisis in the US. Do you know what TARP means? T-A-R-P, the TARP program, or simply TARP, the Troubled Assets Relief Program. The Fed simply put up a fund with, I think, more than $100 billion, and banks could sell their troubled assets, syndicated loan mortgages. They could sell their worthless troubled assets to this fund of the Fed, and the fund would recapitalize and raise capital by giving out money to the banks. So these are two possibilities. You are trying to bail out a bank and to limit contagion effects, and you can try to bridge an unexpected liquidity squeeze. Now, the problem with these bailouts is moral hazard. Why is moral hazard a problem with bailouts?
You can, as a bank, do whatever you want without consequences.
Yeah. Bank managers will be able to act on this. And if you know that your bank is systemically relevant, it's you also call it too big to fail or too interconnected to fail. If you know that your bank is too big to fail, you will increase risk-taking. You will take on more risks than are socially responsible and socially acceptable, and you will take on risk because the return on those risks will go to your shareholders. But if your company, if your bank defaults, you will be bailed out anyway. So moral hazard is a problem, and you have a social contract with society that you can count on society to bail you out. And after more or less this contract with society has been signed implicitly, you know that you can act on this and change your behavior, and you will take on more risks. So moral hazard is a big problem, and one idea to counter this is to bail shareholders in. What is a bail-in? Yeah?
Make them part of the company? Make them part of the company?
Well, they're already owners of the company. The shareholders already own the bank, but what is a bail-in?
They are liable.
Yes. First idea is to make sure that shareholders have to put in more equity in case the bank defaults. And the second possibility to bail someone in is?
They have to let go some of their investment.
That will also happen because if the bank defaults, you will lose all your shares. You can also try to bail in creditors. You can try to bail in the creditors, which means that the people and the companies who have debt, you have given debt to your company, to your bank, and those people and companies who will get their money first they could also be treated just like shareholders. And there are some possibilities to bail in creditors as well. And this is one way to change debt to equity. This will cause your equity ratio to increase. And one instrument that is actually quite clever is a Coco Bond. Do you know what Coco is? What is a Coco Bond? It's a contingent convertible bond. What is a convertible bond? What is a first, what is a convertible bond? Deutsch Wandelanleihe. Ja?
Man kauft eine Anleihe, die sich dann aber über die Laufzeit einen Anteil des Unternehmens
Yeah, close. You start with a bond. A corporate bond is debt. It's a liability. Now a convertible bond, if for example I'm the company, I'm a bank and I issue a convertible bond and you are the investors, you can buy the convertible bond from me and you will be a creditor. You will be someone who has given me a debt, or I have a debt against you. No, with you. I have a debt with you. And you are a creditor. Now, if I default, you will get your money first. But you will only get interest rates on this debt. Now, the convertible bond can be converted from debt to equity. You can choose whether you want to transform your bond into a certain fixed number of shares. In that case, you can decide whether you want to stay a creditor or whether you want to become a shareholder. And it will, of course, only do this if the fixed number of shares is worth more than the bond itself, if equity is worth more than debt. In case equity is worth nothing, you will remain a creditor. So debt will stay debt, and it doesn't. You said that it will change gradually over time. This is not the case. Usually you have the right to choose, and you can choose at any time until, of course, the bond expires. Now, this is a convertible bond, eine Wandelanleihe im Deutschen. But what is a contingent convertible bond? It's a convertible bond, but the option to change debt to equity is not an option the buyer has, but it's an automatic switch if a certain trigger is triggered. If there is a certain barrier that is violated, and usually the contingent convertible bond will be triggered in case the equity ratio drops below a certain level. So what happens? I'm a bank. I will issue a Coco bond, a contingent convertible bond, and you will buy this Coco bond from me. Now you're a creditor. You have a claim against my company, and you will get paid interest rate. But in case the equity ratio of the bank decreases, and I'm in need of fresh capital, of fresh equity, your contingent convertible bond will be automatically transformed from debt to equity, and suddenly you now become a shareholder. What is the advantage of a Coco bond for the bank?
The bank does not need to rely on the customer or on the lender, on the former lender, to use this option.
Yeah, it will not use its option anyway in case I'm close to default. So a convertible bond will not help me. Okay.
If they run trouble, the loans become equities at the moment.
It's an automatic. I think the English word is backstop. backstop. It means that you have one additional line of defense against your equity ratio dropping below a critical level. In case you have a Coco Bond issued or several Coco Bonds issued, you will have the safety that even if your equity ratio falls below a certain level, your equity will be automatically increased by switching the Coco Bonds. But why are you interested in Coco Bonds as an investor? Because this is a disadvantage for you. You will be forced to change from creditor to shareholder in case the company is close to default. Why are you interested in buying a Coco Bond?
Maybe the interest rates are
Yeah, interest rates will be higher. And the last advantage is some central banks might demand and might force commercial banks to issue Coco Bonds, or at least they could incentivize commercial banks to issue Coco Bonds, because of course Coco Bonds are debt at first, but they are different from debt and more safer than debt. So usually central banks will accept Coco Bonds as a part of the calculation of the minimum capital ratio. So although it's not yet equity, it will be included in the calculation of the regulatory capital. So this is one advantage for the bank as well. Okay, what time do we have? Watch with me.
36.
Okay, still 10 minutes. Central banks try to control monetary policy, they try to influence exchange rates, and in many countries, central banks are also concerned with banking regulation and supervision. So we'll talk a little bit about banking supervision now. As I've said, central banks also regulate and supervise commercial banks. And this is done, for example, in the European Union. It's also done especially in the UK, Japan, in almost all other developed countries. And in the United States, for example, the Federal Reserve System has certain regulatory and supervisory responsibilities for the banks in the US. In Germany, it's, well, not more complicated, but just as complicated as in the US. In Germany, we have three authorities. We have the European Central Bank at the top, Deutsche Bundesbank, and the Federal Financial Supervisory Authority, the BaFin in Bonn, which is the Bundesanstalt für Finanzdienstleistungsaufsicht. Banking regulation, in case you didn't know, banking regulation is defined as the setting of rules for bank and banking operations, whereas supervision is the enforcement of set rules, and this is something based on regulation. So what will happen? The lawmakers will set rules, and also sometimes the supervisory authority will set rules, but of course the supervisory authority is concerned with enforcing the rules set, for example, by the German Bundestag. Okay, now let's talk about the Financial Supervisory Authority, the BaFin. It was created in 2002, and in fact, this is a development that could be observed in many countries at the start of the 2000 years. Why? Back 10 or 20 years ago, in many countries, you had supervisory authorities for the banking sector, the insurance sector, and also for stock exchanges. This was the case in Germany as well, and we had the Federal Agency for the Supervision of the Banking Sector, the Insurance Sector, and for the Stock Exchange and Securities Trading. Now we've merged all these three offices into one Financial Supervisory Authority, and this is the BaFin now. It's based in Bonn. It also has a local office in Frankfurt, but only because all the banks are located in Frankfurt. And this is something important. It is subject to the legal and technical supervision of the Federal Ministry of Finance. Why is this so important? Because it's different to Deutsche Bundesbank. Deutsche Bundesbank, the central bank, is independent, and it's an institution that is independent of the state and federal government. The BaFin is part of the executive. It's part, in fact, well, it's not really part, but it's supervised by the Federal Ministry of Finance, Bundesfinanzministerium. And why is this important? Because the BaFin is very much influenced by politicians. Central bankers always take pride in the fact that they are totally independent of politicians. The politicians can ask them to do something, but the central bankers in the end will always decide independently, and especially Deutsche Bundesbank has been very proud of its independence. BaFin, in contrast, is more or less supervised by the bureaucracy and the politicians. So this is different. It's managed by a president and 4 executive directors. They are called executive directors, Exekutivdirektoren, because we have 4 large subdivisions: banking, insurance and pension funds, and securities trading. And the 4th subdivision is just personnel, law, public relations, etc. So this is a very general subdivision. It is the supervisory authority for the whole financial sector, and of course it is also now very much engaged in the supervision of fintechs and small startups in the financial sector. So BaFin has, I would say, it has become, people have started to become more aware of the existence of BaFin. Usually if you would go around and ask people on the street, do you know what the BaFin is? I would say 8 out of 10 people would not be able to answer you this question. But now you start to hear the name BaFin in public news more often, because they have to keep track of all the fintechs and all the startup companies. And quite recently, they have looked at the question whether certain trading agencies and trading companies should be allowed to offer CFD products and other high-risk products to retail customers over the internet. And this is highly controversial, and the BaFin now has the power to prohibit certain products to be offered. And they've already done this. So this is something, this is an instrument the BaFin has only recently been given by the state, and they now can forbid certain trades and certain financial products. Now, they supervise the banking sector together with Deutsche Bundesbank and the European Central Banks. European Central Bank, sorry. And the work division is goes like this. The European Central Bank, within the single supervisory mechanism, is responsible for the supervision of all systemically relevant institutions. Deutsche Bank, Commerzbank, for example. BaFin and Bundesbank are responsible for the day-to-day supervision of all remaining banks. And they do it like this. Deutsche Bundesbank is responsible for the day-to-day operative supervision of all banks, and BaFin sets the general standards and the general rules by which Deutsche Bundesbank is supposed to control and supervise the banks, and they will only step in case anything goes wrong. So they will step in and give out fines. They will penalize certain behavior of banks, but the regular day-to-day supervision is done by Deutsche Bundesbank. In fact, it's done by the local branches of Deutsche Bundesbank, which in German are called Hauptverwaltung, and we have one Hauptverwaltung, one local office right here in Leipzig. And the local office of Deutsche Bundesbank here in Leipzig is responsible for the supervision of all banks in Saxony and Thuringia. So for 2 federal states, and we have one in Düsseldorf, responsible for the western part of Germany, so with a couple of local branches. Primary goal of the regulation of banks and also of other financial institutions is, of course, to secure financial market stability. And another reason why financial markets are regulated is investor consumer protection, lack of transparency of banks. Usually small investors cannot assess the risk of default of a single bank, So customers and retail customers in particular are at a disadvantage, so they need to be protected. And you need to secure the payment transactions and the payment system in order for the economy to work properly. So this is what banking regulation and supervision is all about. Most of banking regulation in Germany is either in European Union law, of course, when it comes to the large banks, but the rest is included in the General Banking Act, the Kreditwesengesetz, Pfandbriefgesetz, and Depotgesetz. Those are the special laws concerning special types of products and also deposits and security funds. This is quite specific to Germany. You have certain laws enacted by the Bundestag and the Bundesrat. By the way, do you have any, especially the foreign exchange students, do you know how laws are passed in Germany? No? Okay. We have a two-tier system. We have 2 tiers and 2 houses. The Bundestag, which is our federal parliament. The federal parliament will enact a law with a single majority. Usually most laws have to be co-signed by the Bundesrat, which is similar to the US Senate. So all the federal states will send representatives to the Bundesrat. The laws are co-signed by the Bundesrat, again, usually a single majority, especially those laws that directly affect the states. And if both the Bundesrat and the Bundestag have passed the laws, they will be signed by the Bundespräsident, the President of the Republic. And usually he will sign anything. It's not like in the US where you have veto power, but usually if both houses have passed the law, the President of the German state will sign any law. It's very uncommon that the President will not sign a law. So 2 houses have to pass the law, Bundestag and Bundesrat. And those are everything you see with a Gesetz in it. These are laws that are usually passed at either the federal or the state level. And these are federal laws. Because financial markets, it's a federal issue. Now, we also have executive and statutory orders. And these are orders which in German are called Verordnungen. A Verordnung is an executive order. This means that, for example, a ministry can enact an executive order, and it can tell people what to do. And usually these executive orders can only be passed within a very narrow range that has also been ruled, or that has also been how should I put it? That has also been this. You need a law. You need a Gesetz for an executive branch to issue an executive order. And I'll give you a very, very good example. For example, in Germany, we have a law that governs traffic. This law is called Straßenverkehrsgesetz. Straßenverkehr is traffic, and Gesetz is law. Straßenverkehrsgesetz. And this law actually says that all streets within Germany have the same traffic laws. So this is a federal thing. It's the same in each federal state, in Saxony, as in Thuringia, as in Bavaria, for example. And the law states that all the specific rules can be decided on by the executive as part of an executive order. So there is a Straßenverkehrsgesetz, a traffic law, but also a traffic executive order. And in German, this is called the Straßenverkehrsordnung. And the exact layout of all traffic signs, they are not part of the law, but they are part of the executive order because it's a very large thing, and Parliament was not willing to act on this and to pass such a law. So the Bundestag only said, okay, we are regulating traffic within the whole of Germany. And the exact layout of the traffic signs, this is something the traffic ministry can do. We do not have to decide on what a stop sign should look like and how large a stop sign is. So this is how laws and executive orders work in Germany, more or less. You have laws enacted by parliament, and the executive can pass executive orders that are concerned with the things enacted in the law. And this is, for example, the solvency regulation, Solvenzverordnung, the minimum requirements on risk management, the MA risk. This is an abbreviation for Mindestanforderungen, minimum requirements. Also the Millionenkreditverordnung und Großmillionenkreditverordnung, the large exposure regulation. Those are executive orders, for example, that require of banks to report large loans. If you grant a loan that is larger than, say, 1 million euros, you have to report the specific details of this loan to Deutsche Bundesbank and to BaFin. And you have to stick to certain minimum requirements in your risk management if you are a financial institution. This is not a law. It's not regulated by Parliament, and Parliament has not acted on this. The Parliament has simply said that BaFin can do whatever it wants as long as it is within its boundaries, within its responsibilities and duties, and as long as BaFin guarantees financial stability. And these are executive orders by the Ministry of Finance, by Deutsche Bundesbank, by BaFin, and this is especially what regulates banks and financial markets here in Germany. And yes, it's all more or less governed by this section and this provision of the KWG, the Kreditwesengesetz. BaFin, it's in a translation, of course. We don't have an English version. BaFin shall counteract undesirable developments in the lending and financial services sector which may endanger the safety of the assets entrusted to institutions, impair the proper conduct of banking business or provision of financial services, or entail major disadvantages for the economy as a whole. So BaFin has the task to guarantee financial stability, and what can it do? BaFin may issue orders. It is allowed to issue executive orders to institutions and their senior managers that are appropriate and necessary to prevent or stop violations of regulatory provisions, or to prevent or overcome undesirable developments at an institution which could endanger the safety of the assets entrusted to the institution or impair the proper conduct, and so on and so on. And this is the central provision of the German Banking Act that regulates and stipulates that BaFin is responsible for safeguarding financial stability in Germany, and it can issue executive orders that are necessary and appropriate. Of course, it cannot punish banks unduly simply because it wants to take over the financial sector, but those measures need to be appropriate and necessary. Okay. Do you have any questions? Because I believe I've now used up enough of your time. If you have no questions, thank you for your attention, and see you next week. Thank you.